If you've been told that saving for retirement or doing a Roth conversion is too expensive because of taxes, 2026 might be the year that changes everything. Hi, my name is Mia Taylor. I'm an enrolled agent and tax advisor here at Mia Taylor Advisors. Today, I want to walk you through what's new for tax year 2026 and why these changes matter, especially if you're a high earner, a retiree, or someone trying to be more intentional about retirement planning. So we're going to start with tax brackets, and then I'll show you how those same changes directly impact Roth conversions and retirement strategies. So, first part is here, why tax brackets change each year. Every year, the IRS adjusts tax brackets for inflation. This is designed to prevent something called bracket creep, where your income increases just to keep up with inflation, but your tax rate jumps anyway. For 2026, these inflation adjustments don't just protect you, they actually create new planning opportunities, especially when it comes to income timing and retirement decisions. I want to start with a 24% tax bracket, 2025 versus 2026 assumption. So we're going to start with married filing joint couple, income source is W-2, retirement income or combined, okay? We're doing this simplified for educational purposes. So for one, tax year 2025, and tax year 2025, the top of 24% bracket for married filing joint was approximately $383,900. Once income exceeds that by $1, you jump to 32%. In tax year 2026, due to the IRS inflation adjustment, the top 24% bracket has increased by $11,000. It's $395,000. Okay. Now, what does this actually mean for you? So to put this into plain English, in 2025, you can earn up to $383,900 before hitting the 32% bracket. In 26, you can earn $395,000, which is roughly $11,000 of additional income. Okay. And that difference matters because when you're making intentional income and retirement decisions, that $11,000 plays a big role. So here's the key takeaway so far. 2026 doesn't just let you earn more at the same tax rate. It gives you intentional planning space. And that expanded space is especially important when you start talking about retirement strategies because income decisions doesn't stop once you retire. One of the biggest 2026 updates that ties directly into this expanded tax bracket is retirement planning, specifically Roth conversions. Many people want to save money for retirement or convert old retirement accounts into Roth, but they stop themselves because they believe it will automatically push them into a higher tax bracket. Well, what's new for 2026 is the expanded 24% bracket gives you more room to convert retirement dollars strategically without triggering a 32% bracket. This goes for all the brackets. I'm just using 24% as an example. The Roth conversion myth explained. A Roth conversion does not mean all of your income gets taxed at a higher rate. Only the portion that exceeds the bracket threshold is taxed at the new rate. That means in 2026, you can intentionally convert traditional IRAs, old 401ks, SEP or simple IRAs up to the top of the new 24% bracket without crossing into the 32% bracket. That makes partial Roth conversions one of the most powerful planning tools for 2026. Now, I want to bring in another framing here for those who are retired or still working and you're 65 years or older. There is an additional deduction for you, okay, for 2026. This gives you, if you're 65 or older, an additional $6,000 deduction. This is on top of your standard or itemized deduction. That deduction can be used intentionally to offset Roth conversions. This can be used intentionally to reduce your taxable income. It creates more room for you to convert retirement dollars at the same tax rate. This definitely gives you a catch-up nest egg. So when we're talking about planning, especially if you're already in that 65-year-old category, it's just cheaper to make these conversions now. It reduces your chance of having to go through mandatory or required mandatory distributions, right? And you are still able to contribute to a Roth forever and ever and ever until you cannot no longer contribute. This is huge for those who are in that 65-year-old age group. Listen, tax planning isn't about avoiding income. It's about controlling when and how that income is going to be taxed. If you want help modeling Roth conversions, retirement income, or understanding how these 2026 tax changes apply to your situation, that's exactly what we do here at Mia Taylor Advisors. And before you go, remember to like, share, and subscribe. It helps the algorithm pick up this video and share this information with others who are searching for real answers around taxes and retirement planning. Listen, guys, I'll see you on the other side. Thank you. Take care.